When a major news announcement hits the financial world, prices jump across the screen in milliseconds. It is a massive storm of numbers moving faster than a human eye can track. For a person watching these screens, the sudden movement is overwhelming. That speed creates confusion, and in high-stakes trading, confusion often leads to fear. This graph shows a moment when a major index dropped hundreds of points in minutes. To a human, that red line looks like a disaster. But computer-driven trading programs don't see a frightening crash. They see a high-speed track with specific structural patterns they are programmed to navigate. Look at this pattern of 3 candles. The middle one is so long that the price effectively skipped a level, leaving an empty vertical space where no actual buying or selling took place. The computer identifies this as a price imbalance. It calculates a high probability that the market will eventually pull back into that void to find the trades it missed, providing a clear target for an entry. These sudden jumps provide the raw data these programs need to find a structural advantage in the middle of a storm. Identifying a gap is only the start. The software doesn't move just because it sees an empty space. It has to be sure the move has enough energy to be real. Without that proof, the system could be stepping into a trap. To verify energy, the system uses a strength meter. It tracks price speed from 0 to 100 across 3 time horizons simultaneously. When the daily, 4-hour, and 1-hour readings align at once, the computer confirms consistent momentum. With every signal in agreement, the program executes the trade immediately, operating with a level of speed a human simply cannot match. By requiring this mechanical agreement across multiple timeframes, the system filters out the false starts that often trick human intuition. Even with a strong move, there is a major problem. How do you manage risk when the market is moving this fast? The software uses a turbulence gauge to protect the account. It acts like an automated traction control system, adjusting the grip of each trade based on current conditions. As price moves become larger and more erratic, the bottom line rises to measure the increasing waves. To the program, this turbulence is a number used to calculate trade size. If the waves get bigger, the system buys less. This keeps the total amount of money at risk exactly the same. The computer automatically shrinks the trade size during chaos to stay within the safety limits. By standardizing risk through math, the software handles the volatility without the need for human guesswork. Once the trade is active and moving in the right direction, the system shifts its focus to securing the gain. This is where people often struggle. We tend to hold on too long because of greed or exit too early because of fear. The software removes those emotions by using a moving safety net. As the price moves higher, this safety net trails behind it, constantly moving up to lock in a higher floor. When the market turns and price falls, the safety net stays put. If the price drops to that level, the system closes the trade instantly. There is no hesitation and no second guessing. The computer simply follows the rule it was given. By identifying gaps, confirming strength, and mechanically adjusting for risk, these systems turn a chaotic environment into a structured, data-driven process.